Okay, guys, we've been patient. People are still dialing in, but I recognize that time is of the essence these days. And so we are just going to get started with a little introduction of who our panelists are today and the partnership between the firms. Today, the topic is COVID-19, mitigating workplace risk and leveraging government assistance. Thank you for joining us. My name is Shayna French, and I'm a lawyer at the Shared Coos team. We have more than 1,500 guests on the call today, which shows how very important this topic is. And we're excited to partner. Shared Coos is a management side labor and employment boutique, and we're partnering with Thorstenson's LLP, which is a tax boutique, which has really been a great opportunity to learn from one another as we work through this program as well. Most of you know Erin. She's going to start with the employment side of things. She's the co-founder of Shared Coos. She's recognized by Lexpert, Chambers Global, Who's Who Legal, and Best Lawyers as one of Canada's leading employment and labor lawyers. She's also a fellow of the prestigious College of Labor and Employment Lawyers. Joining us from Thorstenson's, which, by the way, is Canada's largest law firm practicing exclusively in taxation law. They have a Vancouver and a Toronto office, and we have representatives from both locations today. Ian Humphreys and Kyle Lamoth are partners at Thorstenson's LLP. Ian's joining us from Vancouver. Hello, Ian. Thank you for getting up so bright and early this morning. His practice focuses primarily on international and domestic corporate tax planning for private corporations and multinational groups, as well as providing tailored personal and estate planning advice. Kyle is focused on personal, corporate, and trust planning for high net worth families, professionals, and owner managers and their businesses, both domestic and international, advising on corporate reorganizations, purchases, and sales of business. So we're going to direct you, if you have any questions, please go to thor.ca for the Thorstenson's team or sharedcoos.com for the Shared Coos bios. Erin's going to start our program off today. I'm going to hand things over to you, Erin, because I think there's a lot of material to cover. Starting by dealing with key workplace issues, including leaves of absence, health and safety, layoffs, recalls, and terminations, with a focus on mitigating risk. And before I actually hand it to you, Erin, you know, I like to keep the mic a little extra long. I want to let everyone know today that because of the sheer volume of content and attendees, we're not able to take questions, but we will make arrangements to get the PowerPoint. We're seeing a lot of questions about that already. We'll connect you with that, those materials afterward. So Erin, turning things over to you.
Thank you very much, Shayna. And those might be the nicest words you've ever said about me. So I just want to bask in this moment. Thank you very much. And thanks to our colleagues from Thorstenson's for joining us as well. So we're going to dive in. This is the agenda, and this reflects what went out in the invitation. So we're not going to waste time for the presentation going through the agenda items. We're going to jump right in. So let's talk a little bit about the types of leaves of absences that are available to employees now. Whoop, hang on. I just want to go back. There we go. Sorry about that. This new technology is a bit of a challenge for all of us. We're going to start by talking a little bit about the types of leaves of absences that are available to employees now, and then a quick reminder about some of the leaves that are available outside of a declared emergency. Not sure why these slides are moving, Shayna. Little bit of a weird one on that, but this did not happen in these several practice rounds we did. So I'm going to see if I can take control one more time. There we go. So we start with what we'll call the COVID-related leaves. These are leaves of absences available to employees during the declared emergency around the pandemic. And so these were instituted along with the declaration of emergency. They were made retroactive to January. So that's one of the things that as employers we have to remember. So if somebody took a COVID-related leave or a leave in a circumstance that would have qualified for one of these leaves, even if they took it before the leaves were officially declared in place, it still had to be considered a job protected leave, and these leaves will remain in place for the duration of the declared emergency. So these leaves are available in a variety of circumstances as set out on the screen, and as Shayna says, the PowerPoint will be available after today's presentation. So it can be in a situation where the employee, him or herself, is in quarantine or has been told by public health officials to remain off work. If they need to provide care for somebody, in a COVID-related situation, or simply where the employer directs the employee not to come into work for a COVID-related reason. They may have been exposed, or if they fear they've been exposed to COVID, they've traveled out of the country, although that was certainly more relevant as this started than it probably is now. But that was another situation where the individual wasn't necessarily ill or even caring for somebody who was ill, but may still be required by their employer to remain at home. And therefore, they would be considered on the status of a job protected leave. And so when it comes to the individuals for whom an employee may be caring during the COVID-related times or the COVID leaves, it's a broader swath of individuals than we would normally see covered by employment standards leaves. So you find yourself in a situation where an employee requests a leave or takes the position that they're entitled to a leave, you'll want to start by double checking and seeing if the individual for whom they're caring is on this much longer list of people that would qualify them for a COVID-related leave. And remember, as always, that you may have leave provisions under your own collective agreements for unionized employers that are different or better than the COVID-related leaves, or other ESA leaves may provide payment, for instance, for some part of the leave, where otherwise these are all unpaid leaves. So you'll need to make sure that you continue to comply with those obligations as well. Now, when we soon hopefully get back to a post-COVID world, we also have to remember that there are also leaves under the Employment Standards Act that were already there and will remain in place that may be relevant to somebody who continues to deal with COVID in their household or in their family. So we've got things like family medical leave and family caregiver leave. We've got critical illness leave, and we've set out briefly the circumstances where these leaves can be used. And then of course, there's just the individual's own sick leave. So we just can't forget in this world that those leaves are still available. Now, one of the distinctions between the COVID-related leaves and what we call the post-COVID or the other ESA leaves is the kind of proof that can be requested. When it comes to the COVID leaves, we are allowed to request reasonable proof of the need for the leave, but that proof cannot include medical information. And I think that's simply a recognition that our medical system is so overwhelmed right now, and we certainly don't want people going to see a doctor if they don't need to and potentially exposing themselves to an illness. So for the COVID-related leaves, we are not allowed to request medical notes, but we are allowed to request other relevant proof, like a note that the employee's child's daycare is closed, as an example. Now, when we go into a post-COVID era, when we're dealing with the regular employment standards leaves, we are allowed to ask for medical notes. So that's a pretty big distinction in terms of the kind of proof we can request, and you have to make sure that you bear that in mind. So what if we want an employee to come into work and they're refusing? And this is relevant now or in a post-COVID world. And there's sort of a set of considerations that we think you should run through to see where you're at and see what ability you have to require the employee to return to work. So the first question you should be asking is, are they on a qualified leave, a job protected leave, or do they qualify for a job protected leave, even if they haven't specifically made the request? So if somebody hasn't actually requested the leave, then yes, technically we could say you're not on a leave, you must return to work. But if we know, for instance, that they are caring for somebody with COVID, or they've been told by public health to remain at home, even if they haven't technically asked for the leave, we're aware of those circumstances, it's really not practical or advisable to require them to return home. We would simply suggest that you confirm the employee's status and confirm their status as being somebody on a leave of absence, an unpaid leave of absence, unless you have a policy or a collective agreement that requires otherwise. And then for them to keep in touch and let you know as the employer when their circumstances change. If they don't qualify for a leave, then we need to understand the reason that they're declining to return to work. Is there another medical issue involved? If so, then in those circumstances, we can ask for medical notes. If somebody's saying, I can't come to work for a medical reason that has nothing to do with COVID, we are still allowed to ask for medical notes. Now, this falls in that bucket of just because you can doesn't mean you should. So think hard about whether we really need a medical note. If somebody is suffering, for instance, from an ongoing illness that we're already aware of, and they say that's that illness is the reason they can't return to work right now. If they say it's not a matter of a medical note, it's not a matter of a COVID-related leave, I would really just rather not come to work. the discussion doesn't end there either. Then we need to understand why it is that they're declining to return to work. So if they say, I just generally don't want to leave home, I'm just uncomfortable. There may be circumstances where that anxiety rises to the level of a disability. If there is actually a DSM-5 diagnosis of some kind of an anxiety disorder, then again, we may be in a position where we need to grant the person a job protected leave, not for COVID reasons per se, but because of a general human rights analysis if they are suffering from a disability. But again, in that circumstance, we are allowed to ask for a medical note. But if the individual says there is something specific about the workplace that's causing them concern about returning, at that point, we have to treat it as a health and safety work refusal. And as odd as it sounds in this world, you treat it quite frankly the same as any other kind of health and safety work refusal. The first question is this an individual who was allowed to claim the protection of a health and safety work refusal? We know that certain types of work are actually exempted from the work refusal provisions of Section 43 of the Health and Safety Act. So people who work in the medical field generally, where refusing to do their job might put someone else in danger. We know firefighters, police, that those sorts of jobs aren't actually allowed to refuse work on health and safety on a health and safety basis. But assuming the vast majority of our workforces aren't in those categories, then the next thing is you have to ask the employee to make very clear what it is that's causing them concern about the workplace. Because again, we need to treat this like a health and safety work refusal. So we get them to specify what their concerns are, ideally in writing, but we can't absolutely require that. We can't say we won't deal with your concerns if they're not in writing, but we can certainly ask an employee to put the concerns in writing. And then we have to address those concerns just as we would with a piece of equipment in the workplace if that was the cause of the health and safety concern. So what steps have we taken to ensure that the issue that the employee has raised, for instance, are people properly physically distanced in the workplace? What steps have we taken to address concerns like that? And if we are satisfied that on scrutiny, we have taken all reasonable precautions to protect the health and safety of workers, that we have dealt with the employee's concern, that we have cleared the workplace refusal. It's really hard to do this on the screen. You gotta lift your hands up really high. Once we have dealt with that first level health and safety refusal, then we let the employee know what we've done. We've involved the Joint Health and Safety Committee or the worker rep. And if the employee still refuses to come to work for health and safety reasons to do with the workplace, remember it's tiered, it's not just a general refusal or refusal because of general anxiety. If they maintain that there's something about the workplace that isn't safe to return to, then we actually have to treat that as a second level health and safety refusal, and we need to call the Ministry of Labor so that they can do an investigation. Most of the time, in fact, I'm not sure we've really seen any situation so far where the ministries come on site, and if so, they've been very rare. Generally speaking, the ministry has been doing telephone conferences and have cleared the vast majority, if not all, COVID-related health and safety work refusals. But the key is you still need to go through the process. We're going to switch gears a little bit to talk about some of the tools available to employers to deal with the shortage of work and how we can conserve some cost before we get to the types of programs that Ian and Kyle are going to talk to us about. So the first thing is, we go back to that sort of theme of some people are just anxious about leaving home right now. There is nothing wrong with offering employees the opportunity to take a leave of absence if they wish to. And if we want to cut the costs and we don't have sufficient work to keep everyone busy, so it's in our interest as employers that everybody is not at work, we can certainly ask for people to take a voluntary leave of absence. If that's the case, what we suggest is you predetermine the number of employees you need and what work you need them doing. So we need to downsize by 5 people in this department, 3 people in this department, but for reasons that we can justify, there's nobody we can lose from a 3rd department. So figure that out first, make the offer to everybody in the relevant departments, and then come up with some criteria that we'll use to decide who will get the leave if it's oversubscribed. If more employees would like to take the time off, then we can afford to be down, to make sure that you are adjudicating it fairly and that nobody can later claim that we acted in some way that was biased or discriminatory in the circumstances. Temporary layoffs, and whether people volunteer to be laid off or we institute involuntary layoffs, are one of the tools that, as you can imagine, many employers are using right now. But there are some really important things to remember so that we don't inadvertently increase the risks that we are taking in the course of these layoffs. First of all, under the terms of the Employment Standards Act, an employer can lay off an employee for up to 13 weeks. That's considered a temporary layoff. However, at 13 weeks, that temporary layoff crystallizes and becomes a permanent layoff. In other words, a termination, at which point the employee is owed termination and severance pay if applicable under the Employment Standards Act, and their common law entitlements to termination or pay in lieu of notice of termination also crystallize. So putting it bluntly, at 13 weeks, that employee's employment is terminated. So there are some ways that we can extend that period under the Employment Standards Act. The first thing we can do is we can continue pension contributions or benefit contributions, so we can continue the employee's enrollment in our group benefits plan. And if they pay a portion of that, it can be contingent on ensuring that they pay their own portion. We can set up a supplementary unemployment benefit plan, and if the employee is receiving benefits under that, then they can continue to remain on layoff past the 13 weeks. An employee can agree to be laid off longer than 13 weeks, or we may have a longer period of layoff under a collective agreement. In all those circumstances, then an employee can be laid off under the Employment Standards Act for up to 35 out of 52 weeks. So that gives us a lot more flexibility in terms of when we are in a position to ramp back up. Again, if you hit that 35 weeks, then you have triggered termination entitlements, notice, severance pay, and common law entitlements. When we are laying an employee off, we don't have to specify a period of layoff. We can simply say we're laying you off indefinitely. I'm going to get to in a couple of slides some reasons we might want to specify the period of layoff, but it's not a legal requirement. And then you're going to issue the ROE with the code A, layoff for shortage of work. And as with all ROEs, we issue them within 5 days of the interruption of earnings. We've really got two regimes like we do for a few things when it comes to employment law. We've got the Employment Standards Act, and we've got what the courts say. So I've gone through the Employment Standards Act requirements and our ability to lay people off temporarily without triggering a termination. However, our courts have said that unless we have something either in an employment agreement or something else to which we can point to say that we are entitled to lay someone off, the courts actually say that can amount to what's called a constructive dismissal. The concept of a constructive dismissal is that the employer has taken unilateral action which goes to the heart of the employment relationship. They have made a substantial change to a central term or condition of employment, such that they've effectively said, we're not prepared to employ you under your old terms and conditions anymore. And in law, that's deemed to be a termination. And again, that triggers termination entitlements like common law pay in lieu of notice. Now, that said, in ordinary circumstances and in an ordinary world, an employee could argue after just a few weeks that their employment has been constructively dismissed if they've been laid off. And certainly we expect we will see those arguments made. We're hopeful that the courts will look at the circumstances that we're going through right now and be a little bit more flexible in the implementation of that concept. Not to say that we could lay someone off indefinitely and it would never trigger a constructive dismissal. But we hope and expect that there will be a little bit more leeway from a time perspective than there might have been in a pre-COVID world. But that said, the employer does have some steps it can take to mitigate the risk. One of those is recalling the employee. If a laid off employee takes the position they've been constructively dismissed, one of the first things to think about is to say, we are recalling you back to your regular job. If that's the case, remember, an employee has an obligation to mitigate, take reasonable steps to mitigate any losses they might suffer if their employment is terminated constructively or otherwise. Which means that if we invite the employee back and the employee declines to return, they would have a much more difficult argument that they are entitled to any common law pay instead of notice because they failed to take the most reasonable step to mitigate their losses, simply returning to work when they were invited to do so. But there are a couple of other steps that we can take to minimize the risk of even seeing a constructive dismissal claim in relation to a layoff. First of all, as I mentioned earlier, it's helpful to define the period of layoff. If we know that we're only laying people off for 4 weeks, for instance, first of all, people might be less inclined to be seeking legal remedies because they know they're going to be coming back to work. And they'll find a way to get through this time. They'll apply for the CERB, again, as you're going to hear about more in a few minutes, but they'll hold their powder dry. If it's an indefinite period of time, they are more likely to seek legal remedies and perhaps take that step of making a constructive dismissal claim. You can secure the employee's agreement in writing to be laid off or to be laid off for a certain period of time. Again, it would make it much more difficult for an employee to go to court and claim that the layoff is a constructive dismissal if they have agreed to that change in the terms and conditions of their employment, at least for a defined period of time. And again, as I mentioned, if somebody does make a claim, immediately recall them back to work and make sure that that recall to work is crystallized in writing. Some of the other tools available include reductions in hours and reductions in wages, even if the reduction in wages doesn't go with a reduction in hours. But one of the things to remember is that that reduction in wages, even if it does go with a reduction in hours, can also trigger a constructive dismissal claim. When we are looking at how a court assesses constructive dismissal in the context of a reduction in compensation, there's no hard and fast rule, but generally speaking, the courts look at an annualized reduction of about 10% or more. So when you're at the 10% reduction, and again, that's an annualized amount, not for a short period of time, you are in what we call the danger territory for a constructive dismissal claim. So bear that in mind when you're making your assessments and crafting your strategy about lowering wages, again, whether or not that comes with lowering hours for a defined period of time. And again, that defined period of time is important. If we say to employees, we are reducing your wages by 20%, and we simply say for the foreseeable future, and that foreseeable future goes on 6 or 7 months, you are now solidly into the risk of a constructive dismissal claim. However, if you say we're reducing your wages by 20% for the next 3 months, it's going to be much, much more difficult for someone to make out a constructive dismissal, and frankly, they'd be much less motivated to even try. Also remember that when a court looks at reductions in compensation, it doesn't look exclusively at one thing or another, it looks cumulatively. So if we are reducing compensation, also reducing benefits, and also reducing vacation entitlement, for instance, the court's going to look at the impact of that total reduction in assessing whether we have triggered a constructive dismissal. One of the things to think about if you are in that situation where you are reducing compensation and hours is the EI work sharing program. It's a complex program to apply for and administer, quite frankly, but if it's something you're interested in doing, we have a number of clients who have, and they've found it well worth it. What it allows you as an employer to do is reduce the number of days of work per week, and the employees that are affected by that, and they have to agree to participate, get EI benefits for the number of days they're not working. So for instance, if we reduce the number of work days to 3 out of 5 in the week instead of 5 out of 5, employees will receive EI benefits, so 55% of their regular income to a maximum for those last few days, those last 2 days rather. So that can lessen the impact of the reduction of work, and again, make it much less likely that somebody may file a constructive dismissal claim. Details about the WorkShare program and the very comprehensive application process are available on the Service Canada website. And then, of course, we look at terminations, which is not something that most employers want to do, but many employers are in fact taking that step right now. They're saying, we know that it's really not fair to our employees to lay people off because we know it's just a matter of time. And even when we get back up to operation, we're simply not going to need the same number of people anymore. Some employers are looking at this as an opportunity to really critically look at their workforce, assess who the high performers are, and who are the people they're going to want in that workforce when they're up and running, and making some hard decisions about what that future looks like. If you're going to engage in terminations, the general rules always still apply rather in these circumstances. You want to look at whether you have any employment agreements in place that speak to the period of notice or pay instead of notice. The fact that we are in this COVID-related odd circumstances doesn't change our obligation to provide notice or pay in lieu of notice. We need to make sure that we're not making decisions based on any protected ground, including whether or not somebody has taken a COVID-related leave. And we have to make sure that we comply not only with the Employment Standards Act, but also with our common law obligations, including benefit continuation, unless we have enforceable language in an employment agreement that exempts us from those obligations. As you'll recall, common law obligations look at things like the employee's role, their age, their tenure, their compensation, to assess the period of time it will take that individual to find comparable employment. We do expect that the courts will increase common law notice entitlements during this period, as they have done in other recessionary times, to reflect the fact that it will be more difficult for people to find replacement employment. So consider that when you are assessing your common law offers of payment in exchange for release. And of course, you should get financial advice about the various programs that are available that may help you defray some of those costs. And to give us way more information about that, we're going to turn it over to our colleagues from Thorsenson's.
Sorry about that, guys. Somehow I managed to power through the whole presentation. So I'm going to turn it over to you now and back it up a little bit before I do. I appreciate, before we get into the tax side of things or the government programs, I just wanted to flag that a number of people are on the chat and via email asking about what is to become of the presentation and whether it will be made available. It absolutely will be made available. Shared Coos will be posting it on our website so that that's available to you, and going to turn to the Thorstenson's team to let us know how they're going to distribute it, if it's going to be available on their website as well. With respect to questions, because of the size of the program, we're not able to take questions today. We had over 1,500 people registered, and currently it's showing we have 800 people online. So we're just not able to take questions. But please do, I know that these are complicated issues, please reach out to any of the panelists and we'll be happy to help you. The Thorstenson's team is very available. Ian's got his email address actually saved as his profile name. So that's available to you if you need any assistance at all. So I'm going to turn things over to you, Kyle, so you can take us through the start of your presentation.
Great. Good morning, everybody. So as tax lawyers, Ian and I are involved in really when we advise businesses and their owners, we're involved in specifically where there's big events, big life events in the life cycle of the business, and that certainly applies here with how the pandemic has affected all of our businesses. So what Ian and I are going to go through is the various government assistance programs for both individuals and employees, but primarily focused on the wage subsidy programs for employers. To put them all in context, because there's a lot of acronyms, a lot of programs out there with some unclarity about how they all work together. So that's what we're going to try to clear up as we work through. So first, a couple slides and a couple minutes on the individual and employee measures. Obviously, the largest of that is the CERB, the Emergency Response Benefit. Now, this is a direct funding to individuals, to workers who have stopped working as a result of the pandemic. It's an amount that's a direct transfer to the individuals, and it's obviously there's overlap in the intention of the program with EI. So how it's been administered is any claims made after March 15th to the EI system are now being rerouted through the CERB. In other words, the CERB seems to have completely supplanted the EI system for the period of time that this CERB is going to be in operation. The notes for employers to keep in mind. Like the EI system, well, first of all, there's much lower requirements for qualifying than there is for EI. but there is a system for tracking other earnings of the individuals. And if those individuals earn past these amounts, there's going to be a clawback of the CERB. For employers that maintain some connection to employees who may be claiming under the CERB, we understand at this point certain non-cash benefits that are provided, such as medical benefits to the employees, is not going to affect their eligibility under the CERB. But there are instances where an employer's funding can. One is with subplans, which I'm going to touch on in a second. So benefits under there, it seems that will have an effect under a CERB claim. Also, in situations where an employee may have been laid off, made a CERB claim, and now under the new wage subsidy systems, if the employer is seeking to retroactively rehire the employee, and they're going to pay them for those back periods, that may then affect the eligibility of that employee for their CERB, which they may have already received. So the employee may need to be notified that they're going to have a clawback on their CERB, and at a certain point, they're going to have to repay those amounts, all or a portion of the amounts. The other note here, which is really just individually focused, is that the amounts received are taxable to the employee. How much tax the individuals going to pay is really dependent on their individual circumstance, their marginal rates, what other deductions and credits they have. But they will receive it in 2020. They're going to have to pay tax by April 2021, provided the timelines are still the same when we get to next year. Next, this is the subplan, a supplementary unemployment benefit plan, is not a new measure. It's not a COVID specific measure, but we thought it was really important to mention it in this context. A subplan is a registered plan that an employer can set up to add on to the benefits that an employee who's eligible for EI and is receiving EI benefits to top up those amounts to any amount up to 95% of their eligible, their original earnings. So a payment under a subplan is an exception to the EI system. So it works in conjunction with the EI system. What's unclear now is how this subplan system is going to work in relation to the CERB. As I mentioned, the CERB has supplanted the EI claims, and it's unclear how Service Canada and the CRA and all the different federal agencies that are involved are going to connect these two programs together. So if you're operating and have a subplan in place, or you're looking at putting one in place, you're going to need some specific advice. And at this time, it seems like we do not have clarity how all these systems will fit together. Next, I'm going to move on to employer programs, and there's quite a few programs, and one I think that came out and was the most clear cut was the emergency business account. So this is the loan program to businesses, SEBA. It's actually probably the only acronym that you can properly pronounce. These are loans that are provided through financial institutions, so through your existing relationship with your financial institution. So provided the business was within certain boundaries of the amount of employment income that they were paying to employees during a certain period, eligible for a loan of up to $40,000. That'll be interest-free for the first year. If or provided the loan is repaid by the end of 2022, up to a quarter of that loan, so maximum of $10,000, will be forgiven. As with any forgiven debt or government assistance, there's going to be tax consequences on exactly how that will work out. But assume that generally assume that if you're spending the amount on operating expenses, so real deductible business expenses, there should be no net tax implication, because even if there is an income inclusion for the amount of benefit, you should have an offsetting deduction. The additional mention that I'll have on here that's not in the slides because it hasn't been worked out entirely is the Emergency Commercial Rent Assistance Program. We understand that the federal government and the provinces have an agreement in principle about how this system is going to work. It is going to be a forgivable loan system to landlords landlords who have commercial properties with small businesses as tenants, and those small businesses have had certain effects to their revenue. So if those landlords reduce their rent for certain periods, seems like it'll start for the April period and for at least a 3-month period, then there will be funding to the landlords. So this system has not been worked out entirely. It seems like the final details will be released soon, but we just wanted to mention it, that it will form part of this whole system. Now let's move on to the biggest part, the wage subsidy, the 75% wage subsidy, and also the 10% wage subsidy. Now, together, these are the 10% wage subsidy was announced very soon as one of the first programs that the federal government announced in an attempt to lessen the cash flow impact on employers. The 75% subsidy followed. Now, both have been enacted into legislation, and as you probably know, the window for applications for the CEWS opened on Monday. How these two work together, we've certainly learned ourselves a lot in the last couple of weeks, as there's been greater communication from the various from the CRA and Department of Finance. So what we have to understand is that both still do work, and Ian's going to touch on this and how those affect each other later. But at this point, I'll just mention that they do work in there, but they're for the same purpose. Trying to encourage employers to keep employees on the payroll by subsidizing a certain amount of their wages up to caps. These two programs operate differently mechanically. The 10% wage subsidy operates on payroll remittances. So instead of the federal government sending transfers to employers, this operates on reducing the amount that employers have to send to the CRA as part of their payroll remittances. Now, it seems that the CRA has applied this automatically if you qualify. So it's possible, it seems like probably a lot of employers aren't aware that this has been applied to them already, and they've been making regular full payroll remittances. So this will all have to be worked out in time, and I think the CRA is recognizing that there will be some catch up and some calculations that'll have to be made as everybody catches up. The 75% subsidy operates differently. It operates like a refundable tax credit. So this is going to be, so the way that the legislation works mechanically is that the employer is deemed to have paid too much tax, too much of their own tax. Normally, you think if you pay too much tax, like an individual does through a year, then you file a tax return at the end of the year and you claim a refund for the too much tax you paid. This operates as an automatic refund. So it's a credit. You're deemed to have paid too much tax, the employer. The CRA then recognizes that and then sends checks out. And we understand that checks will start moving hopefully in May. The credit is taxable. So the amount that is received is taxable. I can't lose sight of that. However, when you spend on employee remuneration, that's a deduction. So it should be, provided these amounts that are returned, that are credits, they'll show up as income in the tax return, but you'll have an offsetting deduction because you paid your employees. So the result should be no new net taxable income. However, the amount, just like any amount that is government assistance, can have effects if you make claims under other credit programs. And the biggest one is SHRED. So if you do scientific research, experimental developments, those are very valuable tax credits that startups and employers in certain industries rely on. You'll need to keep in mind that if you get this government assistance under the wage subsidy, it's going to have some effect on your future SHRED claims. Now, who is eligible for the 75% wage subsidy? Generally, we can say most businesses that are operated through any structure, taxable corporation, sole proprietorship, partnership. There's rules allowing charities and non-for-profits to benefit as well. Most businesses and most structures, this isn't where the biggest issue is. So a couple of the carve-outs are really just going to be non-taxable entities and some public institutions. The other big requirement is that the entity that's making the claim has to have had a payroll account before this crisis began. So had to have a payroll account in operation on March 15th. For most cases and most business structures, that's an easy thing to check the box on. For other structures where there may be multiple entities working together, with one entity that has a payroll account and pays multiple other corporations that operate as part of the same business, part of the associated group, that may be more complicated. And there's quite a few rules that are meant to relieve how you look at a structure like that. So structure just has to be a taxable corporation, individual, partnership, has to have a payroll account. But the where most of the meat is in this program is on the revenue decline test. And for that, I'm going to pass it over to Ian to take through the next period.
Thanks for that, Kyle. So again, as Kyle mentioned, this has really been the focus of attention for most employers in terms of the threshold issue of whether they qualify for the 75% Canadian wage subsidy, as the other criteria are pretty straightforward for most cases. And there's a number of different ways to look at it. For your base case scenario, for relatively uncomplicated structures, you're really just going to look at accounting revenues, because again, this test relies on there being a decline in revenue from one period to a next, over as compared to a prior period. So your initial question is, well, what am I comparing? And the answer is you're comparing qualifying revenues, which is a defined term, but it's defined in a way that you would normally think of revenues. Cash receipts arising in the ordinary course of business, with a couple of exceptions. The underlying business activity has to have been performed in Canada. So for entities with operations in other jurisdictions, that might pose an issue in terms of how they're computing their qualifying revenues. The other material carve-outs are you exclude extraordinary items, which is not defined, but I think everyone pretty much assumes that that's what you think it would be, which is you're not going to include one-time items or one-time adjustments as part of your calculation. The other significant carve-out from qualifying revenues is amounts received from non-arm's length entities. And there are detailed rules for determining who operates at arm's length and not. But for the purposes of this presentation, all you need to know is that if you've got inter-corporate payments within the same group, you need to do an adjustment to your qualifying revenues under this base case scenario. And then the final point is that qualifying revenues excludes amounts actually received under the wage subsidy programs, which obviously makes sense because you wouldn't want a circular calculation whereby your subsidies are actually minimizing your revenue decline, and you're having to figure out how to apply with that circular calculation. So that's your initial base case scenario. You're looking at qualifying revenues, and if none of those particular items apply, then really you're just simply looking at accounting revenues as a pretty good starting point. The next part is, well, what am I comparing my qualifying revenues against? And that's where the terminology, the qualifying period, the reference periods, and the specified declines all come into play. And we've summarized those in a chart below. And it's pretty simple conceptually to understand. You're dividing your wage subsidy applications into different qualifying periods. So the first period would have been with respect to March 15th to April 11th of 2020. And the relevance of that period is that's the period for your application. That's what you're basing your calculation on in terms of what you paid your employees. But it's not the period that you're using to calculate your revenue decline. That's the concept of current reference period and prior reference period. And so in most cases, again, in your base case scenario, for that first reference period, you're going to do a year-over-year comparison between March 2020 and March 2019. However, obviously the drafters of the rule realized that certain entities, this would be punitive, unduly so. And the most obvious situation is obviously a high growth business. So they may have grown significantly. They may have been a startup in March 2019. And so even if they've suffered a significant decline, that's not going to show up on a basic revenue decline formula. So the answer to that issue that they've created is to give you an option to elect to compare against January and an average of January and February 2020. So again, there are two relevant prior reference periods in terms of doing this year-over-year decline. And I'll note that the January-February election has some implications for your prior claims, which I'll talk about on the next slide. But the main point is that you do have options here on what you're comparing your revenue decline for. And then the last kind of key term here is the specified percentage, which basically means what everyone thinks it should mean is the requisite decline you need to meet in order to qualify. So for the first period, you would have needed a 15% year-over-year decline, again, in your base case to qualify for the subsidy. That decline has to get more severe for the subsequent periods. However, again, another special deeming rule can come into play that says if you qualified for the revenue decline in the prior period, you're going to automatically qualify for the revenue decline in the immediately next period. And the obvious reason for including that special deeming rule is that they don't want to penalize employers who use the wage subsidy to basically get into a better financial situation and then find themselves unable to qualify for the next period. So it's kind of a ramping off type approach to the wage subsidy. And the last comment I'll make on this is that, you know, there are 3 periods here, but the legislation has reserved the right for the to include subsequent periods after this. And given where we're at, you know, we're almost into the 3rd period already. I do imagine that they will be extending this program to future periods. So again, what I talked about was your base case scenario, which will apply to many businesses, you know, 95% of the time. But obviously, when you're trying to apply a fairly blunt instrument test to this panoply of different type of scenarios, there's going to be fairly common structures that just don't apply based on how the structures are in place. And finance obviously recognized that by including these special rules. Myself and Kyle were talking about this before the presentation, and the reality is you could spend an hour simply talking about these rules, and I don't think anyone actually wants to do that, but you could, and we often have to. But the key takeaways that I want everyone to come away with here is that they really do broaden the scope of entities that qualify. So again, you start with, do I qualify under the base case scenario? And if I don't, that's not the end of the story. You should consider whether any of these special rules apply. The other key takeaway is that there's an interesting interaction between the rules, because some of them do bind you. If you elect into that rule, they do bind you for your subsequent periods. Not all of them do, some of them do. And in other situations, if one entity within a group elects into one of these rules, that can actually have consequential impacts on the claim of a related party entity in ways that are not necessarily intuitive. So those are really the key takeaways. And again, I'm not going to have time to go over all these rules, but I do want to highlight the general thrust of these rules so that everyone is aware that if this applies to me, then I should think about this. The first revenue rule is not strictly a revenue computational rule, but it's the one I touched on the prior slide, which is you can elect to compare to January, February 2020 rather than a year-over-year comparison. And as I mentioned on the last slide, that is binding on subsequent periods. So if an entity elects to do that comparison, they can't switch back to a year-over-year comparison in the second or third period. On the next special revenue, you've got consolidated financials. This one's been, I would say, of less focus than others, at least for our practice. But the basic thrust of the idea is, again, if you have a group of entities that normally compute their financial statements on a consolidated basis, you can unconsolidate them for the purposes of calculating revenue decline. Next one, affiliated groups. It's kind of the reverse. If you have one entity within a large group of organizations that doesn't suffer on its own, the affiliated group concept basically allows the pooling of the revenues for the purpose of the decline test among affiliated parties. So again, it's a pooling type concept of multiple different entities. The special rules for entities involved with joint ventures, I won't go farther than that because it's relatively finite. The next major big one is for intra-group service providers. And again, that relates to, under the normal rules, you cannot include payments from non-arm's length parties in terms of computing your revenue decline. So this rule recognizes that many large groups will have a dedicated entity within the group to provide intra-group services, and you need a special rule to deal with that type of entity. Final special rule is a cash method. So, you know, under the normal test for calculating your revenues, it's on an accounting basis, but there's a recognition that for many businesses, actually receiving the cash might take a lot more longer time than recognizing the revenue. And so that's the election. And again, this is one of the elections that binds you for subsequent periods. So I know that was quite fast, but there really is, we could spend an hour on those rules. So on to your first step of the analysis is, do I qualify? And that's what we've just covered. Your second step of the analysis is, how much do I qualify for? In this regard, the fundamental underpinning of the wage subsidy is it's based on what you pay your employees, and it's paid on what you pay them on a weekly basis. And those are the concepts of eligible remuneration paid to eligible employees. Again, in your base case scenario, there's not going to be too much complications in figuring out what that is, and it's going to tie into your payroll. The one key exclusion for eligible employees is that it does not include employees who are without remuneration for 14 days. And again, to Kyle's comment, this ties into how these programs interact with each other, because presumably those employees would be eligible for the CERB. Basic result, if you've got employee earning more than $58,000 a year and they're being paid that in the period, it's an $847 a week subsidy. If you've got an employee earning less, it's 75% of the eligible remuneration paid. So you calculate all those amounts on a per employee basis, and then you deduct any amounts you are eligible for under the temporary wage subsidy, deduct amounts received under the EI workshare benefit program, which we discussed earlier, and then you add back certain employer premiums. So we talked about base case. Now we're on to special situations in the same way that we talked about the revenue decline test. And I'm conscious of time, so what I'll just say is, if you've got non-arm's length employees and particularly owner managers, assume they do not qualify for the wage subsidy unless they were receiving remuneration between January 1 and March 15th of this year. And on the converse side, if you've got normal employees that have taken a pay cut, you may be able to qualify for more than 75% of what they're being paid, because again, you compute it with their baseline remuneration from normal period of time. And finally, if you've got an employee with multiple employers, you cannot double dip. So you've got a special rule for making sure that they cannot do that. So this is the two programs we talked about. We've talked about the temporary wage subsidy, which is the 10% subsidy, and the Canadian wage subsidy, which is the 75% subsidy. And we thought we'd compare and contrast, because what's come up in the last week or so is that, you know, I think initially most people thought that the temporary wage subsidy was a program that was rushed out the door, and everyone realized soon after that it was inadequate. So it was completely replaced by the Canadian, the 75% subsidy. But that's not necessarily the case, because as Kyle alluded to, The way the temporary wage subsidy works is you are deemed to have made the overpayment, whether you apply or not. And as I noted on my other side, your calculation of the Canadian wage subsidy deducts what you're eligible to receive under the temporary wage subsidy. So again, because you're deemed to have received the payment under the temporary wage subsidy, you need to know what that would be when you're determining what your 75% wage subsidy claim is. And that's really the main point I would stress on this. They're different programs, but you can't assume that they don't interact with each other, and you can't assume away the 10% subsidy program. The final piece of the legislation that is very top of mind for many people is the administrative piece. And obviously, due to the nature of the legislation, that it came out very quickly, there are vast amounts of money that are expected to be paid out under this program. There's some big stick penalties associated with mischief on claiming more than what you are due. The first one is an anti-avoidance rule, which basically targets transactions structured to fit you in within a revenue decline if you were not to qualify other than for that transaction. And so where that rule applies, not only do you not receive the wage subsidy, the employer can be liable for a penalty equal to 25% of the wage subsidy amount. Critically, that anti-avoidance rule carves out just using one of the revenue computational rules. So if all you're doing is using one of the special revenue computational rules to figure out your revenue decline, you don't fall within this rule. Second one, major one, is a false statement, which is obvious in this case. Just do not make a false statement knowingly in your application. And the final point is you can expect your name to be disclosed if you apply for the Canadian Wage Subsidy program. It's unclear at this point whether it will be selectively disclosed or whether every applicant will be disclosed, but you can expect your name to be disclosed. And I know that was a bit of a whirlwind, but I think our key messages here on the programs is that there are a significant number of employee and employer-focused initiatives. The wage subsidy program is by far the largest program, and you can see the numbers quoted above there. Despite them being separate programs, they all interact with each other. Both employers and employees are doing the cost-benefit analysis in determining their courses of action to respond to the COVID pandemic. And with respect to the Canadian wage subsidy itself, it's better to be right than early. The main thing we're seeing is a lot of people, rightfully so, are rushing to apply because they need the cash flow. But if you apply and you're over, then you're worried about the possible application penalties. And if you apply quickly and you actually underapply, there's legislation that suggests that you can actually go back and reapply with the correct amount. So again, it's worth taking the time to get the number right. And with that, I'm going to turn it back to Shanna.
Thank you very much. Ian, I know, and Kyle, there are a lot of really technical questions, and our chat is lit up with both employment law questions and tax questions and hybrids of the two. So I just want to say again that the PowerPoint is going to be available on the Shared Coups website, and it's also going to be available on the Thor website. So please go ahead, give us a little bit to get those uploaded today, but they'll be available today, the decks. With respect to questions, and I know that people have a lot of questions, for those of you who are existing Shared Coups clients, reach out to the lawyer with whom you work. For those of you who don't work yet with Shared Coups, give us a call. We can change that. And I know Thorsten says it's the same thing. Please reach out to them directly, and they'll help you navigate the situation. It's complex, and as Ian said, they could spend an hour just talking about the CEWS criteria. So please absolutely reach out to the lawyer you work with or create a new relationship. This has been a great opportunity. Thank you guys so much for going through the material. I just want to mention that Shared Coups will be holding another scheduled Zoom webinar on Wednesday, June 10th. Our topic is going to be managing in a time of pandemic, employer considerations when business reopens, because that's obviously the next opportunity. So again, thank you all for joining us, and thank you for my panelists for making this such an informative and valuable presentation. Have a great day, guys. Happy Friday.